I am executive editor, Steve Ehrlich, and I'm here with a special guest, Steve Sosnick, the chief strategist at Interactive Brokers. Hi, Steve.
Great to see you, Steve.
So, yeah, Steve, one of the things I really like about you is that you sort of straddle the line between crypto and macro. You're fluent in both. So, why don't you just briefly, before we get started, talk about what you do at Interactive Brokers, especially when it comes to crypto?
My role at Interactive Brokers is as you can see, chief strategist. I primarily come to this from an options trading background. My original role, which when I was hired and then expanded upon for, I've been here now 30 years, was as an options market maker. And what I was doing was basically making sure that our portfolio, we traded, um, literally, we made markets on hundreds, if not thousands, of different options, equity options and related, and made sure basically that our model kept working and that we didn't lose money. Our model worked really well, and I was involved in a wide range. Basically, anything that would come on, with new products, think about like when we started making markets in Netscape, back in the 90s kind of idea. And so as a result, it's forced me to think very generally and very broadly about markets. And as we phased out market making, I got into, writing and talking about the markets, and have now sort of morphed into a full-time talking head, for lack of a better word. But as a result, by needing to stay current and on top of a wide range of markets and activities, I'd like to think that I at least got some fluency along the way in crypto.
Yeah, no, that's great. So let's dive right in. It's been a tough week for markets. I think that the sell-off started last weekend. It seemed like there was a little bit of, I guess, poor enthusiasm following the FOMC meeting. We saw over $1 billion in crypto long liquidations on around Monday or so. And as we're talking right now, the market's bleeding a little bit. I mean, Bitcoin is threatening to fall below 111,000, 110,000. ETH has fallen below 4,000. What are you seeing?
I think that's commensurate with what we've seen. I think there was a lot of enthusiasm for the idea that the Fed was going to cut rates and begin a new aggressive rate cutting cycle. I think what we ended up getting was a little bit of sell the news, buy the rumor, sell the news. The Fed did cut rates. I think there was almost no reason to believe that they wouldn't. I think there was some hope that they would do 50 basis points, but those were pretty minor to call it, somewhere between 5 and 10% likelihood. So the Fed did what it was going to do. I think what then came out was there was some more enthusiasm about the dot plot, the summary of economic projections, where the median is for two rate cuts. But as we looked a little closer at it, as the world looked a little closer at it, we realized that one of the dots was the new governor, Dr. Myron, who was way below everybody else. And as with any median, half the points are below, half the points are above. So it's not clear that we're getting the level of rate cuts and the pace of rate cuts that I think some had hoped for. And obviously, easy money benefits risky assets. And you know, we can have this debate, but I still do put crypto on the risky asset side of the equation. Which, by the way, I put most stocks on that side too. So that's not me picking on crypto. It's
Yeah,
just, let's say, fixed income vis-a-vis everything else.
yeah. I don't think even for this audience, anyone would debate that Bitcoin's not a risky
Okay.
asset. So you're in safe territory here. But I am curious. I mean, the difference between a 25 and a 50 basis point reduction, especially in the context of, I guess, many people are expecting further rate cuts down the line, even if there's some uh, divergence in what the terminal rate will be. Like, would it have led to a real qualitative difference in how investors interpreted the Fed? Like, do you think if they went 50 would have made a big difference in the prices that we're seeing today?
I actually think 50 would have been a mistake, because I think then the mentality would have been, oh my God, what's wrong?
Mhm.
Because the Fed doesn't love surprising markets unless it needs to. And so when you had, call it, 100% certainty that they were going to cut, and maybe an additional, call it 5 to 10% expectation that they might do a little bit more, I think that would have, had they done anything other than 25, that would have led to the questions as to why didn't they? And why didn't they guide us in one direction or another. The Fed is good at that. And so I think 50 would have had people raising the questions. Wait, what do they see that we don't
Mhm.
necessarily? I think as we've started to parse through this, two things have happened, and they're not necessarily unrelated, although they're coming from different places. Number one is I think the reminder, and Powell did touch upon this in his press conference, but he made it more explicit this week, which is, oh, by the way, we haven't really won the war on inflation. And one of the questions in the press conference, which I thought was great, I forget who asked it. I wish I could quote him by name. Was the Fed has always had this 2% target. Inflation hasn't run 2% in years, but yet you're always expecting it to be 2%. How do you intend to get there? Well, you're not going to get there by cutting rates aggressively. So I think he did push back on it because, as we noted in something that we'd written, which, by the way, all my stuff is available at ibkrcampus.com, and just search for my name and you could sign up for free. It's all there. Um, we don't charge for, so please feel free to sign
And
up.
we can probably even link to that as well.
Yep,
In some
that would be
portion.
great. But in general, I, I'd noted there that inflation has been steadily but very slowly rising for each of the past 4 months, whether you measure it by core PCE or core CPI. PPI has been a bit more volatile. Um, but you take those measures, and it's very hard for the Fed to be aggressive under that scenario. So while um, you know, as I think we define the role of crypto as, let's say, a store of wealth vis-a-vis a speculative asset, um, I think a little inflation is good if you have, if you want to view it as a store of wealth, because it's not it's something other than dollar denominated or fiat currency denominated. It's something else entirely, but it is still driven so much by speculation, and so the raw material for speculation is the availability of money. And if you make money more expensive, the
Yeah.
price of speculation increases, whether that's for stocks or for crypto.
Mhm. Yeah. So that kind of leads into the next question I had. I mean, anyone that's looking at price charts can see a pretty drastic divergence in the performance of gold versus Bitcoin that started pretty much exactly on September 18th. What do you make of that? I mean, Bitcoin has tried to have this chameleon-like quality where it can be a risk asset when it wants to be, and it's a store of value when that's more appropriate. But it doesn't seem like it's able to make that transformation right now.
Well, remember one thing. I think of gold as being a chameleon in a similar way. It's sometimes an inflation hedge. It's sometimes the anti-dollar, because it's just a way of having money in something other than dollars. With any commodity, the weaker the dollar, the more of them it takes for it to buy set amount of commodities, whether that's oil, whether that's gold, whether it's pork bellies, fill in the blank. It doesn't make a difference. Um, so gold is classically thought of in those terms. I actually thought on a day-to-day basis, gold tends to act a bit more like the anti-dollar. But I think the divergence, I wouldn't say the divergence has been in place. Gold has actually been the better performer for, let's say, for recent weeks. Obviously, crypto's had a hell of a run. Um, but I think a lot of that is central banks moving out of dollar reserves and into gold reserves, which is not something I think they're really prepared to do in terms of adding crypto as a reserve currency. They're okay with gold because they've been doing that for however many thousands of years. They're okay with the dollar because they've been doing it for, call it, 100 years. But I think they're not ready to do it yet with crypto, which, if that's one of the rationales, then that would be why you'd see some of the outperformance in gold. Secondly, crypto has a correlation with the stock market, and we can go into the various reasons, because I could be more explicit about it. I think you're going to ask me about it anyway, so we'll get to it. But um, but in the short term, there's definitely a bit of a correlation between, let's say, Nasdaq and Bitcoin, just to be very simplistic. And as Nasdaq sort of moves sideways, it makes sense why crypto might move sideways, whereas gold is a bit more of a decorrelating asset, which is is of a lot of value to a lot of institutional investors as well.
Yeah, and we will get into that. But first, I just want to ask to kind of tie ribbon on some of the Bitcoin and gold stuff. What
Yep.
types of questions are you getting from your clients right now, in light of the FOMC meeting and sort of this choppiness in the markets this week?
Well, I think the main questions have been, can gold continue is a big question, and with commodities especially, gold, they tend to be very focused upon trends. I mean, in general, I think I've said many times, Momo and FOMO have been the two big market drivers. And so I think, you're seeing that in gold and I think in commodities in general, momentum, where, I use Momo as the shorthand. Commodities are always very momentum driven. The stock market has been very momentum driven. So I think it's a lot of that. And I think sort of is the next question is, you know, all this money that's being thrown at AI, is it is it just good to continue throwing money at this, or ultimately where's the end game? And I think that's partially why you're seeing stocks. Um, I wouldn't say even have major hiccups, but I think you're starting to see a little bit of a reassessment of, can is it good just for companies to endlessly announce that they're spending ever more money on AI? And I think, as I wrote today, it should just be up on the web. It's that you know this whole ecosystem at some point right now, as it's defined with the big Oracle deal and the big deal between
CoreWeave.
OpenAI and Nvidia. Where's the money going to come from for this? Because OpenAI doesn't generate that kind of. Their annualized revenues in the first 7 months were 12 billion were 12 billion for the year, which created a cash flow burn of $8 billion. How are they going to buy $60 billion a year worth of data center power from Oracle on that? So that's going to require an immense amount of outside capital or an immense generation profitability, which by the way, if you've doubled your revenue year over year, they doubled their revenues on an annualized basis, but they also increased their cash burn eightfold. It's a pretty expensive way to grow. Somebody's got to pay for this. And so I do think the market is kind of starting to reckon with, you know, is this reminiscent, and this is something I introduced on Monday, is this somewhat reminiscent of the rush to build bandwidth in the internet era? Which,
Yeah,
by the way, if you remember names like Global Crossing, Northern Telecom, didn't end well for them, let alone Enron and WorldCom, which were outright frauds. But these were the companies racing to build the data, racing to build the bandwidth. So I think this is the market sort of saying, wait a minute, we're spending a lot of money. We'll stipulate that this technology is indeed life changing on so many levels, but you know, is the path from point A to point B? Um, might there be some potholes along the way?
yeah, and frankly, I think that topic is worthy of its own separate discussions.
Absolutely. I didn't want to
We can
get
do
too
that
deep into it, but I couldn't, I
another time.
couldn't, I couldn't distill it into like
Yeah.
30 seconds. Sorry.
But here's one thing I know this particular audience will be interested in. Bitcoin mining stocks have been sort of buttressed, I guess, even over the last couple of years now, by trying to promote themselves as a hybrid HPC slash mining, uh, uh, that dual type of offering. Uh, they have a lot of compute power. They're already plugged into electricity grids, and then, like you said, there's this insatiable demand for computing power and electricity. What do you make of their prospects, at least as long as this sort of like debt fueled boom is set to continue for, I would imagine, at least a couple more years?
Well, I think it depends on the individual companies. As a business concept, it actually makes a lot of sense. As you say, they've already made the investment in data centers. They've already been buying, the high end Nvidia chips. I think a lot of the market, not necessarily this audience, but a lot of the market forgets that Nvidia 4 years ago was the crypto chip company, not the AI chip
Yeah, to
company.
their chagrin, they tried to shake that label. And
But they talk about a pivot, right? I mean, they pivoted very quickly, and it's worked. But so these companies already know how to deploy these type of chips. They already have the expertise. It's individual case. I don't do individual stocks, so I can't get into the granular nature of company A versus company B. But I would imagine that some of them are in a situation where, number one, if they're mining the crypto profitably, they do have some cash flow. Presumably, they can build out some excess capacity, do it responsibly, and position themselves well. But it's not. But it's tough to build. You're not going to build out the scale that an Oracle can build out. They just raised $18 billion pretty seamlessly in the bond market to build out their data center capacity. So while I have no doubt that there will be individual miners that have a compelling story to tell, part of the whole nature of this AI build out is it is the top heavy nature that this is the battle of the titans, really.
Yeah. So let's talk about a couple of stocks that I know you follow a little more closely just from a trading activity point of view. Some of the digital treasury stocks, MicroStrategy, and in particular Bitmine Immersion, who I know in your most recently released set of top 25 most actively traded stocks, Bitminer was number 10, and I actually don't believe MicroStrategy was in it, even though I
Yeah.
think most weeks it is. So can you talk a little bit about like those two? And to the extent that you follow other DAT stocks, because I mean, it seems to be like getting into a list like what you publish is sort of the critical mass that these companies need to sort of get that options churning going and getting like the volatility traders excited.
Yeah, I mean, I at this point, MSTR is sort of an animal unto itself because it's the giant among industries. Now, as with any industry, as with any profitable business, if you do something and do it well enough, you're going to invite competition. And there was, what I'm going to call it almost financial alchemy going on um, with I'm going to keep calling it MicroStrategy because it's just too hard to
I always do too. I still
yeah, it's too hard to say to use strategy as a noun and a verb in the same sentence. In that sense, a proper noun and a verb. So what Michael Saylor did was he built it out so quickly and so rapidly and rode this run up, um, and I think it inspired a lot of imitators, saying, "All right, wait a minute, this guy he can basically raise $2 for every dollar worth of Bitcoin he buys. This is like financial magic, and it actually got above that. So if you think about it, I'm going to get some argument here because it's not strictly the case, but I think the simplest way to think about some of these things is as a closed-end fund that invests in a crypto, in whatever crypto it is. There's other stuff going on, and I'll stipulate that yes, we could do that. But at its simplest form, they're issuing stock or bonds to buy a cryptocurrency that they carry on their books at book value, and as long as you can issue stock or stock related products at some multiple to book value, it's essentially a money machine, right? I mean, if I can go get $2 from that guy, um, and then turn it around and buy $1 worth of stuff from you and just sort of keep the extra valuation, or use it and it gets carried on the book. You're Of course people are going to want to keep doing that, and so you didn't invite, but they got a lot of competition. And whether it was something like GameStop, always which is always looking for the next buzzword to keep the meme status, or the companies related to the president, or whatever, you started to see companies gravitate to this because it was almost like a magic money machine, and those don't last. And in the case of BMNR, in the case of 8Go, which had the huge run up and flame up, they right there, that's it in a nutshell, right? Because BMNR pivoted to being an ether company, most people were focusing on Bitcoin. They went to Ethereum, and they did get a very prominent um, Wall Street bull talking head with a long track record,
and a terrific head.
um, Tom Lee, whom I met. I don't know him but we have met. And he gave it sort of the proper imprimatur, for lack of a, if I'm trying to think of the right word, but which then was what Aitko tried to do with Dan Ives, who was another famous Wall Street hyperbole behind all these tech, behind a lot of his own tech bullishness. And, that stock ran up. And so that stuff became unsustainable. you can't have a situation where just people will continually pay some amount, basically this premium for something that they're just, that just sits on the books. Again, it doesn't necessarily just sit on the books. We can
Yeah.
lending it out, et cetera. But it's one thing if you're doing it for a company that has, you know, where they're, let's say an Nvidia, where it deserves a price to book multiple because they are doing something that others can't. In these treasury companies, most of them are doing something that everybody else is doing. So most closed-end investment funds tend to trade plus or minus 20% around their net asset value. In this case, they don't do net asset value; they do book. We're starting to see that fade. MicroStrategy is somewhere closer to about a 50% premium, which you could argue, given their heft, it's high, but not necessarily a screaming short. Some of the other ones are screaming short. Some of the other ones flamed out. But I do think that's a sign of froth. It's also, it's analogous to what we saw with the SPACs in 2021, which was, give me money and I'll figure out something to do with it. In this
Mhm.
case, it's give me money. I'll go out and buy crypto, which I'm assuming most of the people who are listening to this can really know where to just go out and buy crypto, right? I mean,
Yeah.
and
Yeah.
so
Yeah,
so
that's a
why
question.
pay why pay someone for the privilege
Yeah, that's
of
a
a hot
question comes
stock
up a
rap,
lot.
basically, is what it was.
Yeah. And one of the trends that we're seeing are people pivoting to assets that maybe aren't like longer tail assets that maybe aren't as readily available to people, but that's obviously more of a niche market than Bitcoin, Solana, Ether.
Exactly.
Just quickly, one last question to wrap
Sure.
up. I'm interested in what markers or signs, what types of data you're looking at in the next week or two that'll really sort of drive the market. I know we get a new PCE reading tomorrow. What do you expect out of that, and what could be coming next week?
Well, the core PCE, not the well, the PCE number that came out today was a little bit higher than expectations. It was 2.6, not 2.5. That's usually a pretty good clue. Um, I don't have the expectation right in front of me, but I'm expecting no major improvement in that number, considering how much considering how much consumption went on. Consumption is a little bit fluky at this point. I've written about, the K-shaped recovery, and if you think about the vertical line in a K being the y-axis, where do the points meet? And I think we went from having sort of a small K to a capital K to now we're probably an upside down K. But so it's an uneven level. And then as we get into next week, we get into employment reports, and this market is hyper focused now on labor. We got weekly jobless claims today, which were surprisingly good. We're at a point now where everybody's hyper focused on weekly jobless claims. There's a lot of noise in those numbers, but I think that's if everybody's focused on labor. So these are the things, basically it comes back down to the Fed's dual mandate: inflation, core PCE being their preferred measure, labor market, which is next Friday, a week from Friday, being non-farm payrolls, unemployment rate. And oh, by the way, it's looking increasingly likely that we're going to have a government shutdown sometime next week, September 30th into October 1st. On the IBKR platform, we have event contracts, and when I last looked earlier today, that's predicting about a 60% chance of a government shutdown, and that's up pretty dramatically from where it was last week. So that's a sort of exogenous factor that you have to keep your eye on, because that's going to have implications for the bond market. And another thing I'm watching very closely is the shape of the interest rate curve, whether we start to see a real steepening, which will tell us that um, there's a little bit more of a cost being placed on longer term assets, whether that's bonds, stocks, crypto, et cetera.
Awesome. Great. Well, Steve, thanks for joining us. We'll have to have you back. Thanks again, everybody.
Thank you.